Good morning, everybody. Or I guess if you're watching the replay, this might even be good afternoon, good evening, or what the heck are you doing up at this hour? My name is Brian Burke. I'm Managing Director of Praxis Capital and President of Praxis Residential. Welcome to Santa Rosa. The historic Round Barn is over my shoulder. And I'd like to say thank you for attending this webinar today. Have a few things to cover. This is the Carriage Place webinar. We expect this webinar will take 20 to 30 minutes, during which time we'll talk about Praxis, our track record, the market, and the opportunity. So let me show you some visual aids that I have for you today. That way you don't have to look at me all day. I'm sure nobody wants to do that. So first, we'd like to welcome our longtime loyal investors. And also, we'd like to welcome those of you who are new to Praxis. And there's a number of folks on this webinar who are new clients of Praxis. And for those of you that are unfamiliar with us, Praxis is a true value investor. We look for discounted properties and opportunities to buy below replacement cost and below market value. My partner on this property is Chris Peterson, who should be a familiar name to many of you. Chris and I have acquired and repositioned hundreds of houses together and hundreds of apartment units in Texas. A couple of years ago, he moved to Texas to help facilitate our multifamily footprint there. And our multifamily platform, in that platform, we specifically seek opportunities with a compelling backstory. In a moment, we'll talk about that compelling backstory of our current offering. We've been very fortunate that our growth has been fueled primarily by word of mouth and referrals, but we're also very fortunate to have received some very favorable media attention, which has contributed to our brand awareness. There have been some flattering articles written in the mainstream media that have featured some of our accomplishments, and we've been interviewed on many real estate specific podcasts and been featured speakers at some prestigious investment conferences, and we're honored to have been a part of all of that. Our focus is on value add properties where we can perform some type of turnaround. This allows us to be more cycle resistant. We like to buy low, improve the property, and sell higher rather than the typical multifamily focus of simply relying on the market to carry the day. To find these opportunities, we typically underwrite about 100 properties, which results in writing 10 offers just to buy one property. And that's been a historical average that we've maintained year after year. This time it took us longer. It took us 160 properties to underwrite to find Carriage Place, and the reason for that is twofold. One is that we're picky and disciplined, and the second is if you look at last year, we didn't buy anything at all because the overheated buying climate propelled every property outside of our criteria. Why do we like multifamily? Well, in part because the fundamentals are very favorable right now. There are a lot of components to the story of why rents are rising, and we could spend a lot of time just on that. But what's important right now is that we are swimming with the current, and that adds extra momentum to our strategy. So we have to ask, are rents still rising, or is that all in the rearview mirror? Economists believe there is still room to run, but don't just listen to me. Take a look at what the experts have to say. Reese Inc. is a very well-respected demographic and research firm in the multifamily industry, and they just boosted their rent growth forecasts in light of the prevailing economic fundamentals. But here's what we do. We take an underperforming and neglected property and we turn it around. Sharing just one example of that, the property that you see on your screen here was bought in Austin, Texas. It was originally acquired with a 5-year hold forecast. But our improvements were so well received by the market that we were able to exit in less than 2 years and produce an amazing return for our investors, completely blowing away all of our financial forecasts. Buying the property right is critical, but in my opinion, what's just as important as buying right is the sponsor behind the asset. I see a lot of offerings by other multifamily sponsors. I'm sure you do too, but one unfortunate common element that I see in a lot of these is a lack of a great sponsor track record. I think previous performance should play a front and center role in your analysis of an investment sponsor. We get a lot of questions about it here, and folks are interested in what we've done in the past to determine whether or not they want to be involved with us in the future. So I think there's a couple ways to gauge performance. One is by looking at the return, which is fairly simple. Most sponsors will put that somewhere in their marketing materials. But I think an even better way to get inside the brain, a better way is to get inside the brain of the investment sponsor. You want to see how they underwrite. So to facilitate that, let's examine a couple of our properties that we sponsored in the immediate area of Carriage Place. So here's what we'll do. Let's compare the forecasts we made in our original marketing materials to the actual performance that we achieved. And the reason I want to do that is because every sponsor will tell you that they underwrite conservatively, and we tell people that all the time, but few can prove it. So let's prove it. I tend to underwrite with a very conservative economic occupancy forecast. So for those of you who aren't familiar with the concept of economic occupancy, let me just give you a quick primer so that you can be on the same page with us. Economic occupancy would be at 100% if all of the apartments were rented for full asking price and everyone paid in full and there were no vacancies or concessions. Now, of course, that never happens because there's always some loss from tenants who fail to pay, leases that haven't climbed to full market rate yet, concessions that you offer to attract new tenants, vacant units waiting to cycle, model units that aren't rented at all, or units that are rented at a discount to property on-site personnel. So to come up with economic occupancy, what you do is you take the difference between the actual rent collected and the full market rent. So many sponsors, they fail to realize the power of this concept. They focus strictly on physical vacancy and ignore the other components of economic vacancy, which in my view are just as important. So bearing that in mind, it's worthwhile to study the economic occupancy that we forecast when we originally acquire a property and give you guys a marketing package, and the economic occupancy that we achieve after we've acquired the property and stabilized it. So let's take Elm Grove for example number one. Elm Grove is located less than 15 miles from Carriage Place. In years 2, 3, and 4, you can see here that our actual performance was far better than our initial forecast. So you might ask, what happened in year 1? What went wrong there? How did you guys miss the economic occupancy in year 1 so badly? Well, to answer that question, let's examine the income. The chart above shows the average monthly income for each year of the 4 years that we owned the property. And here you'll see that year 1 was almost equal to our forecast. So how could that be that the economic vacancy was so much higher but yet the income was right about on target? Well, the answer to that is that we set higher rents than we had expected to set. And that higher rent target caused a wider gap between our asking rent and our actual rent initially. But as you can see, the strategy worked because by setting that higher target rent from the outset, it allowed us to form a base of higher market rent that we were able to escalate over the subsequent 4 years. And in every year after year 1, our actual income far exceeded our forecasted income. So looking at what that meant to us at the end of the day, if you notice, we had a forecasted sales price of this property of $9,032,500. That was our forecast that we set before we even bought the property. Our actual sales price, though, was about $500,000 higher than that, actually more than $500,000 higher than that, and we achieved that asking price a year earlier than our projected 5-year hold time. So I think that speaks well to track record and initial underwriting. So a couple of things I want to point out here. One is we forecasted the internal rate of return on the Elm Grove investment at 24%, which was a pretty high target to achieve. We haven't counted all of the profits yet. We just sold this property last month. But so far, all of our indications are that we're going to exceed that forecasted 24% internal rate of return. Another thing I think is important is notice that the sales price of the property was $70,588 a unit after we bought it for under $40,000 a unit. That $70,000 exit valuation will come up again later in this webinar, so that's important to keep that in mind. Let's move on to another example. Whispering Oaks is another property that's currently in our portfolio about 20 miles north of Carriage Place. Once again, you'll see here that our economic occupancy has been greater than our forecasted economic occupancy, and our projections appear to be on target, if not conservative. However, you see that same year one phenomenon again here in Whispering Oaks, but wait till you see this. Take a look at the year one income. We set our rent target much, much higher than what we had originally forecast, which allowed us to grow the income at a far greater rate than we had anticipated. And that's the difference between that economic vacancy forecast and the actual economic vacancy. It's that spread between our asking rent and our actual rent. So I think that's a good thing. We forecasted that this property would perform at a 16 IRR to the investor's net. We fully intend to beat those projections, and you can see by the income that we're certainly on track to do so. So let's get to the property at hand. Today we're here to talk about Carriage Place. We've got this property in contract in Houston, Texas. So a lot of times people will ask us, how do you select a location? Where should we be investing? We have a strong track record in Houston, and we believe in Houston's economy, and here's why. Houston was ranked number 7 out of 200 major metros on the Milken Institute's annual Best Performing Cities Index, which was up 1 spot from the previous year. The report specifically pointed to phenomenal wage growth as a factor in the metro's success. But you can't think of Houston without thinking of oil. There's a lot of talk in the media lately about falling oil prices and a lot of reminiscing of the problems falling oil prices caused in the 1980s. But Houston is a much different place now than it was then. With a widely diversified economy, there's jobs in many sectors that are outside of the influence of energy in the Houston economy. Texas A&M University's Real Estate Center says that falling oil prices are not stopping Texas job growth. Unemployment at 4.2% is one of the lowest in the country. CNN Money just ranked Houston as number 2 on a list of the fastest growing U.S. cities. Their report said that even with the downsizing in energy employment, Texas' diversified economy has one of the lowest unemployment rates in the country. This is Exhibit A of that phenomenal growth, just as direct evidence. Take a look at this picture of the Exxon campus, currently under construction, only 2 exits north of Carriage Place. This massive undertaking is only phase 1 of this campus, which is expected to be complete later this year and house over 10,000 employees. This campus is 385 acres. It's been called a game changer and is one of the largest construction projects underway in all of North America. One independent economic study estimates that the campus will create 44,000 permanent jobs in the region. Looking at the map, you'll see that this property is very close in proximity to Carriage Place. And the other 2 properties that I just covered with you that were in our portfolio, Elm Grove that we sold last month and Whispering Oaks, it's currently in our portfolio, are in the general vicinity of Carriage Place as well. Also benefiting Carriage Place, in addition to the ExxonMobil campus, directly next door to Carriage Place is a 400,000 square foot regional distribution center for CVS, currently under construction, scheduled to open later this year. On the other side of the adjacent Class A apartment complex next door is the regional medical center and its related doctor's offices and supporting businesses. And there's a large office complex and retail campus just down the street. The property is also very close to Houston Intercontinental Airport, which houses thousands of jobs. But you can't think of Houston also without thinking of apartment complexes springing up all over the place. But that doesn't seem to be the case in the Champions/FM 1960 submarket, which is where Carriage Place is located. This submarket has not had any new product in 2014 and no new product in 2015 so far. Only 118 units have even been built in the last 5 years. Reese projects that in the next 5 years, less than 250 new units will be built in the submarket. And with the economic activity taking place there, it hardly seems to be enough to accommodate the demand, especially given this new Exxon campus that's going in. But I mentioned earlier that we don't just rely on the market to carry the day. So let's get on with it and talk about the property itself. We look for properties where we can actually do something to improve the value. The economic tailwinds for us are just a bonus. This property, Carriage Place, it's a tired, neglected property. It just lacks curb appeal, but it perfectly fits the mold for another successful Praxis turnaround. So why now do we have to? So we now have to ask, why doesn't the current owner just do what we're planning to do? And I mentioned in the beginning of this webinar that the backstory is always really important. And one of the first questions I ask a broker when looking at a new deal is, what is the story? Why is this seller selling? And why is this an opportunity for me? So this, in the case of Carriage Place, the owner of the property is a large apartment sponsor, and they're well known in the industry. But they bought this property at the wrong time. They acquired it in 2005. Before they could implement their turnaround plan, the economy tanked, and they were just doing what they could to hold on. They rode out the recession and waited for better times, but they had to wait so long that this property was the last one left in this fund, and they owned properties grouped together in a fund. Unlike what we're doing, where we buy one property per entity, they set up a fund, a blind pool. Basically, investors contribute and they go out and buy a series of properties, and this is one of the properties that was contained within that fund. But by the time the economy came back and they could finally sell this property, it was the last one left in the fund. In order to renovate the property, they would have had to do a capital call and raise money from their investors to accommodate it, and they didn't want to do that, and I guess their investors didn't want to do it either. And they were left with no choice but to liquidate the property to return their investors' capital, and their losses are gain. One thing I think is important to note is that this property is, it's that property that everybody wants but can never seem to find. It's that elusive Class C property with upside located in a Class B neighborhood. It's textbook. We've done this before. We showed you this property earlier in the webinar. That we take the ugly property and we turn it around, and we're going to show you that we're going to do that again. This property lacks curb appeal. Like I said earlier, it's ugly, it's dirty, and it's neglected. I call it perfect, and I think you'll call it fixable. For example, take a look at the leasing office that's just really uninviting. With some simple landscaping, we can transform this drab leasing office into something that looks upscale. Imagine how it'll look even better when the building has been re-sided and painted. But we won't stop there. The ugly cabinets shown on the left will be modernized, and the avocado counters from the 1970s will be upgraded with a modern look. You can see the examples of that on the right-hand side of your screen. New kitchen appliances and flooring will really make this kitchen pop. In the bathrooms, they'll be upgraded and modernized with new cabinet fronts, countertops, and plumbing fixtures. And the outdated flooring in the interior, the parquet's out of here. Paint, carpet, wall texture, plumbing, and electrical fixture upgrades will round out the improvements. This will transform this Class C complex into one that will compete on a level playing field with the nearby Class B properties. And we've done this before. A lot of these finishes are the same ones that we've used at Elm Grove and Whispering Oaks. On the financial side, we're buying this property for around $12.2 million, or exactly $12.2 million. It'll cost us around $2.5 million to do the physical improvements, nearly evenly split between exterior improvements and interior improvements. Despite all the capital expenditures, our all-in basis of the property will be far below replacement cost if you were to assume that it would cost $90,000 a unit to build a property like this. Because the property looks so bad, the current owner has just focused on being a low-priced leader in the neighborhood. So to that end, they haven't kept up with market rents. Despite the property's ugly condition, it's still 97% occupied, but the way that they've gotten there is they've just charged a lower rent than market, and that's allowed them to stay full. Without swinging a single hammer, we can immediately raise the rents from an average of $588 a month to $644 a month. That's what comparable properties in poor condition are renting for in the submarket. But with a fresh new look and desirable living units, we can take the rents even further. We can go to an average of $810 a month, which is consistent with rents at other nearby upgraded properties. Increasing rents ultimately increases the property's income, and increasing the income by definition increases the value of the property. By year 3, we expect to have increased the income to the level that would bring the property's value to $20 million using a 6.5% capitalization rate. At that point, we have multiple exit strategies. We can sell and capture the gain, or we can refinance and hold. With a $20 million valuation, using an 80% loan-to-value refinance, that would yield a $16 million loan. If you remember our purchase price of 12.2, when you add all of the costs, we will have a $16 million capital stack between our financing and the equity that we raise. So if we're able to refinance with a $16 million loan in year 3, we will be able to recover nearly all, if not all, of the investors' invested equity to return back to you upon that refinance. So what we're going to do here is, like we've done in the past, we'll acquire the property, improve it, and then watch for the right time to exit. So it might mean that we refinance, and it might mean we sell. We have a lot of options here. If the market isn't right at the exit point, to exit at that point, we could hold it and watch for the right time. What's important is for us to manage market cycles and be prepared to either use them to our advantage or wait them out. We have a lot of options that we can do. And remember that I mentioned that we just sold Elm Grove for $70,500 a unit. That $20 million valuation shown on your screen would put Carriage Place's value within $2,000 a unit of that price that we just sold Elm Grove. So we believe this is very achievable. As we've done in the past, we conservatively project our economic vacancy and our income. We showed you some charts on that earlier. On this property, we've done the same thing, and we expect this time to beat those projections. This year, I've done something a little bit different. You'll notice in year 1, we have a 39% forecasted economic vacancy, and that's why if I go back a slide, you'll see year 1 net operating income and value declining from where they have been in the past. I don't really think that's going to happen, but we're forecasting for it anyway. So we shouldn't see that year 1 anomaly that we've seen in other properties. Just a couple quick notes since I'm back on this slide, because I forgot to cover this. You'll notice at the top there's a chart of numbers. The first left-hand column says T12. That's the trailing 12-month income the property has achieved to date. So in other words, their net operating income, which is the first line, is just under $750,000. That's the income the property has generated over the last 12 months, which puts the value at around $11.5 million using that capitalized value. Now, if you take what they've earned over the last 3 months and annualize it, which is a little bit better indication of where the in-place income is today, but still use trailing 12-month expenses, the net operating income is $877,000, which yields a property value in today's market of about $13.5 million. Remember, our price is $12.2 million, so we are buying it under market value, and we know this because there were offers higher than ours that the seller did not select because they felt that Praxis had a better track record and a higher likelihood of closing than our competitors who bid higher. The next column over is the year one pro forma. You'll notice that I've dropped the pro forma income in year one to $560,000. To do that, we would have to have a significant move out event. And I do anticipate that when we raise rents, a lot of these folks who rented here because it's the low price leader will leave. And we're planning ahead for that and building in that possibility. But by year two, we'd be back to where we should be, and by year three, we should have achieved our targets on rents. So just getting back, I want to talk about the financing. We'll start the financing with a bridge loan. This type of financing is designed to fund a property repositioning, just like the one we'll do here at Carriage Place. The loan is 5% interest with a 3-year term, and we have the option to extend up to 2 times, each for 1 additional year. After the first year, we can pay the loan off without penalty, whether either through a sale or a refinance. At year 3, when we implement the refinance plan or the exit plan, if we elect to refinance at that stage, we expect that permanent financing will be available upon stabilization at a rate near 5% with 30-year amortization and a 10-year term. If the lending climate is not ideal upon stabilization, we have the option to sell the property and take our profits or extend the bridge loan for 1 to 2 years. Wrapping up here, our due diligence was completed last week. During our due diligence period, we inspected the interior of each of the 276 units. Our contractor inspected the exterior. Our management company performed lease audits. We reviewed all service contracts, examined all utility bills, shopped all of the competing properties in the area, and obtained contractor bids for the major work. The result of all of this extensive due diligence is summarized in our consultant's due diligence executive summary, which we will give you access to. If you wish to invest in this opportunity, you'll receive a link to our due diligence vault, and you'll find the documents in there. In addition to the due diligence analysis, you'll also find copies of all of the data, contracts, historical financials, rent rolls, contractor estimates, utility bills, unit inspections, the purchase contract, the lender's term sheet, and this executive summary, all contained within the due diligence vault. When you click the link to the due diligence vault that you received from Bob, it might ask you to log in or create an account. The service we're using for this is Dropbox. If you have a Dropbox account, you can log in. If you want to create an account, you can. It doesn't cost you anything, but you don't need an account. If you just simply close the dialog box, you'll be taken straight to the data vault, and from there you can view and or download all of the materials that you'd like. The lender won't provide all of the capital stack, so this is where you guys come in. We're raising $5 million from our loyal clients and from some new clients as well. At least 10% of the equity will come from the sponsors and immediate family. We forecast an internal rate of return to our investors of over 17% using conservative assumptions. Of course, all of this is dependent upon us hitting our targets, but as you've seen, we've been known to not only hit our targets, but to exceed them. However, my legal counsel wouldn't be happy if I didn't mention that past performance does not guarantee future results. For those of you who are sensitive to paying taxes, there are 2 ways to benefit from this investment. We do accept investments from your self-directed IRA or qualified plan, or if you're investing non-retirement funds, you can benefit from depreciation, which will provide paper losses to offset your real income. We'll accelerate the depreciation into the earlier years of the hold period by performing a cost segregation analysis. We've done this on our previous properties, and it's allowed us to use faster depreciation schedules for some of the building components. The typical result has been that all or nearly all of the cash flow during the first 5 years of the hold period is completely offset by depreciation. So essentially, you're getting income tax-free during the hold period, and then you make it up at the end at a lower taxable rate. So now we got to get to the point with how do you participate? You need to know how you get in. So if you've already put your name on our interest list, Bob will be sending you an email with the link to the due diligence vault and a copy of the private placement memorandum and a subscription agreement within the next 24 hours. If you have not put your name on our interest list already, or you don't receive the email from Bob within 24 hours, please contact Bob right away to request the documents. His email address and phone number are on your screen, and you probably also saw it in the signature line of the email he sent you to register for this webinar. The private placement memorandum is one of the attachments that you'll receive to Bob's email. This is the legal disclosure that we are required to provide. It contains the details of the offering and a copy of the LLC operating agreement. The document is for your examination. It's 100 pages. You don't have to print it if you don't want to, but we do encourage you to review that document. The second document that you'll receive is the subscription agreement. The subscription agreement is the document, it's the actual document that you'll use to apply to be a member. Print this one out, and then on the left side margin of the document, you'll see instructions on where to initial and sign. You'll indicate the amount that you wish to invest and complete the investor qualification questionnaire that's attached to it. And of course, if you need any help with completing the subscription agreement, reach out to Bob. He'll be happy to give you a hand. He can also help coordinate with your self-directed IRA custodian if you're investing through a self-directed IRA. Once that document's completed and filled out, send that in to us along with a deposit comprised of 10% of your investment amount. This will hold your place in the offering. Once we've admitted you to the company, we'll send you a welcome letter and an executed copy of your subscription agreement. Subscriptions will be accepted on a first-come, first-served basis, so I encourage you to get them in sooner rather than later. Once we reach the $5 million in commitments, we'll close the fund. Any subsequent subscriptions that we received beyond that time will go on our waiting list. That's not necessarily a bad thing. If you do end up on our waiting list, we won't deposit your 10% deposit check. We'll hold that uncashed and only deposit it if you actually get admitted. If you don't get admitted, we'll return your 10% deposit to you. We will not, being on the waiting list does not mean that you're obligated to invest in the next property or the next fund. That's specific to this property only. There has been a very high degree of interest in this opportunity. We expect it will be fully subscribed very quickly. In early to mid-July, we'll issue a capital call to all subscribed investors for the balance of your investment funds, the remaining 90%. If we don't receive your funds by the announced deadline, we'll be forced to disenroll you and admit a waitlist investor. So I encourage you to watch your email for the capital call notification. Finally, I want to put up a link to our marketing package. I don't know if you received this or not, but most of you should have seen the marketing package. It's probably why you're on this webinar. But if you haven't, on the right-hand side of your screen, there's a button you can click to download a copy of the marketing package for your review. This concludes our webinar for today. Of course, we're happy to answer questions and assist you with the process. I encourage you to reach out to Bob. I'll put his contact information back up in case you need to touch base with him. He can assist you with the subscription process and anything else, answering any questions. If you have specific questions that we didn't answer in this webinar, feel free to reach out. We're happy to either answer by email or set up a conference call. And we look forward to partnering with you on this one and having another successful practice opportunity. Thank you for your time today.